Hi. So now we'll discuss the other topic, the calculation of gain and losses from realization of assets and liabilities. So again under the company taxation. If you can recall, under the company taxation, the first topic what we discussed was transitional provisions. The second one was chargeability and the calculation of income tax liability. Third, income source chargeable with income tax. Finally, we discussed deduction rule in calculating the income sources. So before come to the company taxation, there is one more small part to be discussed. It's about the capital gain. Though the people used to say capital gain, but technically it's not capital gain, the wording should be the gain and losses, gain from realization of assets and liabilities. Normally we call this a capital gain chapter, but not actually capital gain. I clarify that one. Chapter 4, this is on chapter 4, the Inland Revenue Act, starting from section 36 to section 51. Deal with calculation method of gain and losses from realization of assets and liability. So before discussing the calculation method, first I would like to emphasize you what is this particular topic is on. Then the calculation of gain or loss. In calculation of gain or loss, what do you mean by cost of an asset? What do you mean by consideration received of an asset? What is realization? It comes in only in the income to realization. What do you mean by realization of asset? Cost considered received and realization of a liability. Reversal quantification, the compensation, that is a reversal items. This is something special. There are certain realization types, how to calculate the consideration received and cost, the amount derived and the cost. Look at those, what are those instances? In those instances, what are the consideration received and cost? Finally, payment of tax on capital gain is a apportionment of cost and consideration received, that is section 51. That is a small part. Take one by one now. What is this topic is on? Yeah, as we discuss when it comes to income source, the business income, would like to recall you section 6 subsection 2 item C. Okay, look at on that. It says the gain from realization of capital assets and liability of the business should be included in calculating the business income. But how to calculate the gain or gain given chapter 4? That's what we are going to discuss now, chapter 4. Okay. As we know, capital asset is defined under section 195, interpretation section, covering few assets, no? Not all the capital assets in general. Maybe land and building, membership interest in a company or partnerships, and the rights and options related to those assets, etc. Only few, not all. So we have clarified already in detail the definition of the capital asset. Please go to the definition and look at that simultaneously. So that is one already we have done. This is taxable as a capital gain or business income. See, business income, section 6. But the calculation, you follow chapter 4 that we are going to discuss now. The second instance we came across chapter 4 calculation method is under section 7, the investment income, item subsection 2, item B, where we discuss the gain from realization of investment asset should be taxable as investment income. What is investment asset? Those capital asset held as a part of investment. That is what we are called, this is what we are calling as a generally capital gain. But how to calculate? Again, this particular provision referred to chapter 4 that we are going to discuss now. Okay. Third instances we came across chapter 4 was that in calculating the business income or investment income, the section 17 says the losses from the realization of assets and liability of the business shall be deducted in calculating the business income. Is something like other side of section 6 to C, 6 subsection 2 item C, that is the first part. Other side of this, your gain brought under section 6, your losses claim under section 17. Though it's used the word asset and liability, if you go to that particular section, it says only capital assets and liability of the business. The capital asset used in the business, the liability is taken, created to make use of the business. If your losses, you must claim under section 17, gain taxable as a business income under section 6. Here again, how do you quantify the loss? Chapter 4. They have in short, the gain arising from the realization of capital assets and liability of the business should be taxable as a business income. Corresponding loss deductible under section 617. The gain from realization of investment asset taken as a investment income. All three calculation you have to follow chapter 4. That's why I am going to discuss now. Okay. Start with section 36 subsection 1. The calculation of gain tells you a gain from realization of assets and liability shall be the consideration receipt exceed the cost of the asset at the time of realization. That in other words, when you realizing the assets or liability, the gain shall be consideration received minus cost at the time of realization. Section 37 deals with the cost of the asset. Section 38 deals with considered receipt of an asset. Further says, a gain made by a person for realization of investment asset shall be reduced by any part of the gain in calculating the income from an employment or business. A gain made by a person on the realization of an investment asset shall be reduced by any part of the gain in calculating the income from employment business. In other words, don't bring the gain from the employment or business into the gain from investment asset, because the rate is different. The gain from realization of investment asset should be taxed at 10%, where the business gain taxed by 28%. You have to separate it. How to calculate the loss? Other side. The losses from realization of assets and liability should be where the cost exceeds the consideration received at the time of realization. Okay. Take application check 50 for continuation. A company which is engaged in manufacturing of articles or manufacturing business has disposed a block of land for 100 million during the year of assessment 1920, where the cost of the asset is 80 million rupees. For this company's land, this particular block of land is not a business asset, could be taken as a investment asset. No. So the gain from realization should be consider received 100 million minus cost of the asset 80 million equal to 20 million rupees. So then gain should be taxable under section 7 subsection 2 item B as a investment income, or we call capital gain. So it's taxable at the rate of 10%. We will discuss later on income tax rate as per first schedule. Question 55. So the same company, let's say, when they dispose the shares for 80 million rupees, whereas the purchase cost is 100 million rupees. So you have a loss. The loss of realization. The consider received 80 million minus cost of the asset 100 million. The negative 20 million loss. How did I this loss? It's a business loss or investment loss. So manufacturing company hand the shares are what? The business asset or investment asset? Yeah, it's held as a part of investment. See, investment asset. Share is a capital asset, no doubt, as per definition. Any capital asset held as a part of investment become investment asset. They have this particular share. If you have a gain from previous investment asset should be taxable as a investment income. If you have losses, you must recognize as an investment loss. According to section 19 subsection 5, you can claim, but we discussed the previous discussion. According to subsection 5 of section 19, the gain from realization of an investment asset shall not be reduced by any loss from the disposal of another investment asset. Therefore, the loss on the disposal of an investment asset should be deducted from the gain from arising from similar investment asset. So in short, since the company had a losses from the disposal of share, this particular 20 million you can set off only against the gain from disposal of same investment asset being shares. According to subsection 5 of section 19, this loss you can't set off against the gain realization from the another investment asset, maybe land or building. Okay. So I clarified the calculation method with the application of the relevant section, maybe to deduct it or not. Okay, this is a continuation, you see. I will take one by one. Cost of an asset, section 37 deals with quantification of cost of an asset. According to subsection 1, the cost of an asset should be the sum of, that means the total of 3 or 4 in other words. Expenditure incurred in acquiring the asset, including expenditure on construction, manufacture or production. If acquired, then cost of acquisition. If constructed, cost of construction. If manufacture or production, cost of manufacturing or production. Depending on the mode of acquisition, the real original cost you take as a expenditure. expenditure in acquiring the asset. So, apart from that, the cost of an asset also includes expenditure incurred in altering, improving, maintaining or repairing the asset during your lifetime of the asset while you are being owner of the asset. If you done some alteration to the asset, the alteration cost you can claim. If you done some improvement to the asset, the cost of improvement you can claim. Maintaining or repairing the asset during the lifetime or during the period of your ownership, you can claim them. Some of these are capital expense, some of these are revenue expense, does not matter. But practically, you see, how can you quantify this question now? Why? Because this law came into operation from 1819. I would have incurred these expenses in my ownership period, maybe 10-15 years before even. Now I don't have records, that's a problem. Anyway, that's a practical issue. Incidental expenditure incurred in acquiring and realizing the asset. The subsection 4, section 37 will discuss after this, clarify what are those incidental expenditure are. Plus an income item referred to in subsection 2, also deductible as a cost. The cost of an asset shall not include consumption expenditure for the consumption, you can't claim. Excluded expenditure, any expenses are not claimable. In expenditure to the extent to which it is deducted in calculating the income source or included in calculating cost of another asset. So, this expense already deducted in calculating the another income source, you can't claim. Or this cost is already included in cost of another asset, you can include, then you are going to have a double claim. You can get a double benefit from the income set off against the income source. You can't have a duplication, no, that is the reason there is a provision like this. So, what do you mean by incidental expenditure? These three expenses are recognized as incidental expenditure, you can claim as a cost of an asset. What are they? Advertising expenditure, do advertisement, maybe at the time of sale would have been realization. Transfer taxes, maybe at the time of acquisition or realization. Duties and other expenditure of transfer. The expenditure for establishing, preserving or defending ownership of the asset. The legal expenses incurred to defend the ownership of the asset, you can claim as a cost of an asset. Though it is not actually a cost of asset, here you can claim. The remuneration you paid over the period of time, services of an accountant, agent, auctioneer, broker, consultants, legal advisor, surveyor or valuer relating to the expenditure in A and B. That is the first two items. Okay, that is expenditure on the advertisement, etc., and preserving the ownership related to that. These are considered to be incidental expenditure, which is in turn part of the cost of the asset according to section 37 subsection 1. Okay. All this you can claim as a cost of an asset. Section 37 subsection 4 is to say, where an asset or a liability owned by a person used in producing more than one source of income, then you can apportion that cost and cost of an asset or liability based on the market value. It is not really related to the apportionment, but related to this cost of asset. The application check 56. Though we are focused on the corporate tax, I mentioned here the individual tax also, maybe because the capital gain to test mostly the capital gain. The individual has disposed an house which was given on rent, that is investment asset clearly in March 2020. He has incurred the following expenditures. What are those expenses he has incurred? He has made the payment to a seller in 1985 in acquiring the property for 1,550,000. There is a cost of an asset in acquiring. Expenditure income connected with the acquisition 150,000, maybe any brokerage, any other expenses. Cost of improvement made in 2010 for 1,020,000, that also recognized as cost of an asset. Cost of repairing during the period of his ownership 750,000. Repairing also during the ownership you can claim, but provided you do not claim this amount, you are not claim this amount against any other income source. How do you quantify the cost of the asset according to section 37? Cost of acquisition 1,550,000. Expenditure in acquiring 150,000. Yes. Cost of improvement 1,020,000. Yes. That's all. So I have not taken the repair cost on the basis that it was deducted already in calculating the rent income. So therefore, since you have calculated the rent income, you have already claimed the repair cost. Then according to section 37 subsection 3, you can claim that same expenses against the cost of asset. Otherwise there will be a double claim, no? Okay. Why you not taken the improvement on that same basis? Because the improvement, of course, you can't claim against the rent income, because it's a capital expenditure, no? You can't claim. It's very important rule here. This was brought up not under 37, section 37, as a transitional provision. You know, section 203, we go to the Revenue Act, it's about the transitional provision. Subsection 4 says this particular rule. That means this was taken up at the last stage, drafting this law. But when you come to investment asset, only this is applicable, not all assets. Though this chapter applicable for a capital assets and liability of the business, this is applicable only for investment asset, that is capital asset held as a part of investment. This is another capital gain calculation. What is this? Any cost of an investment asset as of 30th September 2017 should be equal to market value of the asset as of 30th September 2017. In other words, accrued capital gain, increase of capital gain during the period of ownership up to 30th September 2017 should not be taxed. So that's what happened is, you know, this new act came into operation from 1st April 2018. You would have sold before that, no capital gain tax under the previous act. Since you sold the asset after 1st April 2018, you get caught into the capital gain tax. Though you get caught into capital gain tax, the prior gain earned during the prior period under the previous Inland Revenue Act should not be taxed. On that principle, they have brought up this particular transitional provision. Then the question comes to you, should I have been 30th September 2017, not 30th September 2017, should I have been 1st April 2018? Yeah, that's could have been the case, but the original idea was to bring the capital gain tax from 30th September 2017, halfway through. That's why they have brought up this one, but later on they postponed the implementation of the new act along with the capital gain from 1st April 2018, but they could make a change on this particular provision. That's what happened. I think so. Therefore, this principle is very important. Therefore, accrued capital gain up to 30th September 2017 should not be taxable. That's the reason, though the capital gain was introduced after 1st April 2018, in the 18, 19, 19, 20 period, I don't think the government would have got more capital gain tax revenue to the government, no? Why? Because of this 30th September rule. The gain would have been very small amount. Sometimes if you sold the house today that has been bought maybe 30 years before, almost a major gain is covered under this, not going to be taxed because it's going to be a part of the cost. You push up the cost to the market value. So, the gain will be very small amount. Okay. Don't go and apply this one for all the assets, including capital asset of the business now. That's the problem. If you are recognized a capital asset of the business, you don't apply this, but capital asset of the if it is the investment asset only, this could be applicable. They have an asset to be recognized as investment asset, you have two advantage. One is in calculating the gain, the cost you can apply the market value, so that the gain will be reduced. Second advantage is the applicable tax rate is 10%. Okay. So, now I will come to consideration received, section 38, sale value. The amount received or receivable of an asset, including the fair market value of a consideration in kind, determined at the time of realization. If you have sold or realized in monetary terms, amount received or receivable. If a consideration are going to be received in kind, fair market value at the time of realization. Okay. And also that covers amount derived by the person in respect of owning the asset during the ownership. Amount derived from altering, decrease the value of the asset. So, that let us say you are during the ownership you dispose the asset part by part, that now we have to take it as a consideration received. Amount derived from the asset, including by way of covenant in repair of otherwise. Finally, amount derived by the person on entitlement for the person to derive an amount the future in respect to realizing asset, also you must take it as a consideration received. So, basically sale value. Section 38 subsection 2 provide for consideration received in granting of an option, could be a share option or any other option, where it says the consideration received for the realization of an asset shall include consideration for the grant of an option in relation to the asset only if the person has not been subject to tax in respect of income or gain made on the grant of the option. If you already taxed, do not tax in this. Otherwise, in granting option, if you receive money, take that as a considered receipt of an option. To give an example for this, let us say the company A is a grantor of the option, has given an option to acquire the block of land to company B, grantee, for a consideration of 2,500,000 for a period of 3 months. Company has given an option to buy the land or buy the property to company B for a money of 2,500,000 for 3 months period, given an option only. So, look at the test implication on this following. Where the company B exercise the option and acquire the block of land. Secondly, the company B without exercising the option has sold the option to company C for a sum of 3 million rupees. In case of first one, where the company B exercised the option, then the company B would have paid 2,500,000 to company A. So, company have a gain of 2,500,000, that is a consideration received, no cost for the company A, the gain is 2,500,000. But second case where company B without exercising the option sold the option to company C for 3 million rupees, then there will be gain to company B, consider receipt from company C 3 million less the amount of cost that we paid to company A 2,500,000 purchasing the option. So, the net gain is 500,000. Okay. Clear? So, in case of first one, company A given option to company B to buy the property for a 3 million within the period of 3 months. Option is given for 3 months. For that, the money is 2,500,000. If you exercise the option, the company A receives 2,500,000, not the property sale value, option consideration. So, a whole thing is gain to company A. Company B without exercising, if he sold the option to company C, company A anyway will receive the money 2,500,000, that is a gain. Apart from that, company C also will receive by trading the option 500,000 gain. Okay. The consideration received shall not include exempt amount as per third schedule, we discussed already. For example, if you dispose the shares of a company in a listed company shares, that is exempt from tax, that amount you can't take it as a consideration received, no. A final withholding payment, section 88. I don't think any of the final withholding payments are there in relation to the sale value. Thirdly, other than in case of trading stock or an amount to be directly calculated in the person income. If you already taken up this particular income under any other source of income, don't take it again. Otherwise, there will be double taxation. No? Likewise, we discuss the expenditure you can claim double. Similarly, income also should not be taxed twice. Okay. The application take 58. Oral question. The realization of asset together with the cost and the consideration received. Let us take an individual. His house, that is investment asset, is sold on 30th January 2020 for a sum of 35,800,000. His expenses were the cost incurred in acquiring the asset in 2010, 80,900,000. Stamp duty paid at the time of acquisition 755,000. Cost incurred repairing and improving during the period of his ownership 2,850,000. Cost incurred in relation to advertising made for the sale of property in January 2020 150,000. Commission paid to the broker who introduced the buyer 567,000. Finally, market value of this property as at 30th September 2017 was 29 million. So, here since it is an investment asset, according to section 203 subsection 4, since the investment asset was held as at 30th September 2017, the cost of the asset should be market value as of 30th September 2017. So, by which I think you have to ignore in that case item number 1 that was incurred prior to that. It's all registered in your market value. Stamp duty paid? Yes. Repair and improvements? Not clear. It was incurred subsequently or before that. It was incurred in 2010. The property was bought more long time before. We'll assume that was incurred prior to that. Ignore. But last two item, I think that was incurred at the time of sale. No, it's not adjusted in your market value, so you must be able to claim. So the compilation will follow the capital gain calculation. Consideration received 35,800,000. The cost of the asset, ignore section 37. Market value asset 30th September 2017, 29 million according to the transitional provision because investment asset. Cost are reduced by the time of sale in 2018 under 50,000 or at the time of sale must be in 2020. Commission paid again 567,000 altogether 29,717,000. So the gain shall be 6,83,000. This gain should be taxable at the rate of 10% under the first schedule. Thus I said here, there are double benefit here. There are two benefits. What are they? If you calculate the gain, you can claim the market value as of 30th September, so that the gain will be less. Even lesser gain, the rate of tax is 10% rate. Okay. So the important discussion, section 39. Now we have done the gain calculation of asset. Section 37 about the cost, again subject to investment asset, transitional provision given. 38 about the consideration received. Now the calculation part is over. So this chapter will apply for the realization of the asset. So what do you mean by realization? It's very broader than the sale. The realization includes sale, but not only the sale. So in all, each and every realization, this calculation will follow. So section 39 tells you what are the way the asset could be realized under the Inland Revenue Act. So person who owns the asset should be treated as realizing the asset under one of the following situation. A, when that person parts with ownership of the asset. Parts with ownership of the asset means what? Change of ownership of the asset. Including means whether ownership passed or not. These things you have to consider as a realization. The asset is sold normally, exchange with another asset, transferred. For example, holding company transfers asset to subsidiary company. This is realization. Distributed, realization. Cancelled. In cancelled, there is no ownership transfer, but the ownership is going to be ceased. So, realization. Redeemed, again realization. Destroyed, nobody going to be owner after destruction, but still considered as a realization. Lost, no ownership transfer, but ownership ceased. So, realized. Expired, the expiry period is over, or the validity period is over. Expiry, again realization. Expropriated or surrendered. Here you see, it's very, very broad. Here what is happening is some of the cases there is a change of ownership happening. Some of this case ownership going to be ceased. So where is very broad under A. In case of asset of a person who ceases to exist, including the death of a person, individual. Immediately before the person ceases to exist. In case of company, maybe at the time of liquidation, in case of individual, at the time of death. Immediately prior to the death is considered to be the ownership is ceased, so there is a realization. That means there is a capital gain tax for the dead person also. So actually, the A and B are there is a ownership, maybe a transferred or ownership is ceased. But hereafter, from C onwards, normally we call deemed realization. Not actually there is no change of ownership, but the law require you to consider as a realization. Though the ownership is the same person, you see. So that in that mindset you must read from C onwards. In the case of an asset other than trading stock or a depreciable asset, so that for the trading stock and depreciable asset this law does not apply. Case of other asset, what are they? Maybe on a capital asset or investment asset, where the sum of consideration received from owning the asset exceed the cost of an asset. Moment during ownership there can be a part realization, no? Moment when you receive advance or even part realization value is exceeding the cost, that point you must consider that as a realization. Okay. Sometimes you may be continue to be owner, but for income tax purpose it has been realized. Yeah. In the case of an asset that is a debt claim owned by a person, the person reasonably believes that the debt claim will not be satisfied, bad debts. The person has taken reasonable step in pursuing the debt claim, the person write off the debt as bad. The bad debts write off. I think we already discussed section 24 subsection 4, the previous discussion. Bad debts claim you can claim against the business income. What is this? Yeah, section 24 subsection 4, to claim the bad debts, the debt amount should have been declared as a income on accrual basis, no? But such a condition is not here. So whether you are claiming well under section 24 or not, if the debt amount will not be paid, write off of debt, you can consider that as a realizing the asset. So when you realize the asset, you have to work out what? Consider receipt, year 0, the entire cost of the asset, the debt amount will be a cost. So that amount could be deductible, in other words. Where the cost exceed 0 consideration received, the whole amount can be deductible as a realization loss. It's very important. Item E. The case of trading stock, a depreciable asset, capital asset of a business or investment asset, all 4 assets are covered. Immediately before the person begins to employ the asset in such a way that it ceases to be an asset of any of those types. There being status quo of the asset change. For example, when asset status quo change from the trading stock to depreciable asset, there is a considered to be realization. When asset was depreciable asset to trading stock, there is a realization. When asset changed from investment asset to capital asset of the business, there is considered to be realization. When the asset is depreciable asset to investment asset, considered to be realization. Therefore, you see the owner going to be the same owner, but character of the asset got changed. So, therefore, when the movement when you change the character of the asset, that time it is considered to be realization according to section 39. What is the logic on this? Yes, I think there is a logic. Otherwise, what will happen is, let us say for example, you have a asset of capital asset of the business you have. While the asset was kept as a capital asset of the business, and if you realized, your gain will be taxable at the rate of 28%. No? In order to mitigate the tax, you can transfer that asset to a investment asset, classify as an investment asset, and then you sell to get a lower tax rate. Can you do that part? No. So, though you sell while you are in investment asset, the moment when you transfer the capital asset of the business to investment asset, that point of time there is a gain realization. You got to calculate the gain and taxable at 28%. Okay. Can be other way around also. Finally, the circumstances referred in section 70. You go to section 70, deals with change of residence. The new act is highly technical. We will discuss later on when we come to the non-resident taxation, section 70. When a change of residency occurred, let us say an individual, he was a resident becoming a non-resident, or he was a resident, non-resident becoming a resident, then in those situations, there are certain type of asset is considered to be realized, though ownership is going to be same. So, this purpose of this is, we will discuss that time, to avoid the loophole. Okay. That is very clear now. Section 37 or 39, A and B, to a certain extent you can say there is a change of ownership, or ownership is ceased, but C, D, E, F normally we call deemed realization. Okay. All things are considered to be what? Any of the things happen in an asset, A to E, A to F, we call that asset is being realized. Okay. Now, look at the cost of an asset, cost and consider receipt of a liability. The cost and consider receipt of a liability. Normally, we are familiar with the realization of the asset, no? But here, this chapter is, remember, not only for realization of asset, the realization of the liability also. We have given the example, do not worry. First, we will discuss the provisions, we will come up with the example later on. What is the cost of the liability and consider receipt for the liability realization? The cost and consideration receipt for a liability for a person shall be determined in accordance with same section 37 and 38. We discuss section 37, cost of the asset. Same thing you have to apply for a cost of liability also. We discuss section 38, consideration receipt for a asset. The same section 30 you have to apply for a consideration receipt for the liability also. As though refers to the asset, in those section where it refers to a liability, expenditure incurred realizing the liability is included in the cost of the asset. Oh, sorry. The expenditure incurred realizing the liability is included in the cost of the liability. Apart from that, section 37 and 38, if you incur an expenditure in realizing the liability, settling the liability, when you incur the cost of settlement of the liability, you consider as a cost of the liability. In amount received in incurring the liability, that is when borrowing the money, that you consider as a consideration received for the liability. Normally, in a case where the income come to asset, cost comes first at the time of acquisition, the considered receipt comes at the time of realization, no, sale. But here, when it comes to realization liability, considered receipt comes at the time of occurrence of the liability, when you receive the money. The cost taken place at the time of settling the liability, later stage. Okay. What is realizing of the liability? We discussed section 39, the realizing of asset. The section 40 subsection 2 deals with how a liability could be realized. Where a person owes a liability, shall be treated as realizing the liability where the person ceases to owe the liability. The liability is going to be ceased, including when the liability is transferred to another person, satisfied, that means settled, cancelled the liability, or liability is expired. This period of liability over, expired. Similar way, asset, in the case of liability of a person who ceases to exist, including a death of a individual, immediately before the person ceases to exist, considered to be the liability is realized of him. Again, in the case of change of ownership, also the liability could be realized. We will discuss the come to non-resident taxation. Yeah, we will work out the example, application check 59. Very important to understand the liability realization, right? Let us say a holding company given a loan to a subsidiary company for an amount of 30 million rupees. We have to look at the implication due to this settlement of this liability under the following situation. But the holding company decides to consider the loan outstanding as investment in shares. Accordingly, what has happened? The holding company's books of accounts, the investment in the loan given to a subsidiary company going to be changed as investment in shares. The subsidiary company books of accounts, earlier it was a liability of loan to the holding company, loan to the holding company going to be transferred to a share capital. The book adjustment. But 11, yeah, in this case, the liability is realized, no? The liabilities became realized and now become share capital. The as a liability concern is ceased. Okay? Still, company owe, not to the lender, shareholders. The liability is realized. There, the gain should be what? Yeah, what is the consideration received at the time of increase the liability? 30 million. When it, at the time of taking the loan, 30 million rupees. What is the cost of the liability? Though we are not paid, we issued a shares, that is incurred a cost, 30 million rupees. So, the gain is 0. The actual gain is 0, no? You can't have an income statement, any other gain. The accounting also there can't be a gain. Tax point of view also there can't be a gain. Why? Yes. The money received at the time of borrowing the money, 30 million rupees. First 30 million rupees is what? Borrowed money. This minus second 30 million rupees, cost incurred in realizing the liability. What the cost we are incurred in realizing the liability? Transfer to the share capital, you owe money, 30 million, resulting 0 gain. Look at this option. The holding company decided to write off the loan. Then, again, the liability realized as far as subsidiary company is concerned. What is the liability? Gain. Yeah, 30 million, that is a loan obtained minus, though the liability is realized, we are not incurring cost. So, 0 cost. The whole 30 million rupees become a gain. Okay. So, the books of accounts also, there should be a gain 30 million, where the income you declare somewhere else, the financial statements of the subsidiary company. Tax point of view also there is a gain 30 million. It is very interesting to see whether how we are going to tax this gain, is it taxable? So, according to the understanding, I think the gain from realization of liability could be what? Only if it is a liability of the business only. According to section 7, subsection 2, item C. Sorry, according to section 6, subsection 2, item C. Yeah, if you have a gain from realization of liability of the business, should be taxable as a business income. If not a liability of the business, can be taxed. There is a question come, this liability of a company, subsidiary company, is a liability to the business. How do you know? You have to see whether the money has been used for the business purposes. If it is used for business purposes, become a liability to the business, then the gain should be taxable as a business income. But if it is not a liability to the business, I think there is no provision to tax the gain, no. Okay. The third situation, the old income recovers out of 30 million rupees only 25 million and agreed right of the balance 5 million rupees. Again the liability is realized, the gain shall be, but the money received, borrowed money 30 million rupees consideration received, less cost of realizing the liability, releasing the liability, only 25 million we paid. There are 5 million is my gain. So, the books of accounts also there will be a profit of 5 million. The tax point of view also you have a gain of 5 million rupees, right.